Hey guys, Nathan Robert here. The year 2024 is pretty much over and it's been a great year. So I want to give you a total stock portfolio update. I'm going to show you every stock that I own, how much I'm up and down on them, how much I own in them. I'll also share with you my Roth IRA, all of my dividend income, what stocks I'm looking to buy next year, and also my other portfolio right here because we actually have two different portfolios. We have our Robinhood account and our Moomoo account. So I'll show you literally everything that I own. I'll give you my thoughts on all my stocks. And if you like this kind of stuff, don't forget to drop a like on the video. Let me know in the comments how your portfolio did in 2024. Because if we look year to date right here since January 1st, we're actually up 29%. We've actually done quite a little bit better than the S&P 500 because the S&P 500 is up 26%. So we're doing just the slightest bit better. And here's my strategy for this portfolio in here. Literally, I only own dividend stocks in this portfolio right here. Actually, every stock in here pays a dividend, and all these are in the S&P 500 except for one, except for my largest holding, which I have a prediction will be in the S&P 500 in the next couple of years here. But you've probably heard a lot of these names. Like we've got Salesforce, we've got McDonald's, Constellation Energy, Google, Meta, and Realty Income. This is kind of my 7 stock portfolio right here. I really just try and concentrate on a few high quality names here. It's kind of like Bill Ackman. He has a multi-billion-dollar portfolio, but has less than 10 holdings. And then I'll give you a quick update on this account. Then we'll go into the stocks individually and why I really like a lot of these names. So as you can see in here, we have some popular names in here as well. Like we have Disney, Nike. We do have some stocks in here that do not pay a dividend, like Perion Network down here. This one does not pay a dividend. I always recommend, like, if you like a company and you want to buy it, you should dollar cost average into it DCA, but that doesn't always work. So make sure you're dollar cost averaging into a high quality company. We also own DocuSign, which does not pay a dividend, but they had some really good earnings and mainly some really good guidance. So they expect to go back to double digit growth, is what the CEO was saying. Because right now, I'll be really quick with this. If we look at their top line sales, they're only up 7%, mid single digits. It's nothing crazy. So the good news is that they're probably going to go back to double digit growth. We've also been dollar cost averaging into Disney. Like I said, this one also just rose their dividend to 50 cents per half a year. So you get $1 annually for this. So it's still under a 1% dividend yield. But I like to see that Disney's growing their dividend yield. Disney cranks out free cash flow. I'll show you that really quick. Look right here, the FCF on Disney right here, the free cash flow. It was $4 billion in the most recent quarter, and it's up 17% year over year. And we can see their premium subscribers. As you know, Disney owns ESPN, Hulu, Disney Plus, all those different streaming services, just kind of like competing with Disney. And they have 150 million paid premium subscribers, which is kind of cool. Another stock I've recently been buying into is ticker symbol Cube or CubeSmart. This is a real estate investment trust, and really, as interest rates and bonds go lower, so the yield goes higher, it really affects CubeSmart because they really rely on getting new capital at really low rates. And looks like they're not going to be able to do that. So the stock prices begin to hit. Anyway, this one has a 4.78% dividend yield. That is a very good yield. So I'll kind of just hold on that one to the long term. It's sort of like Realty Income. Another stock I just bought, check out EOG Resources. This one's in the oil and gas industry. They have like $3 billion of net cash. Look at how they raise their dividend every year. They have a 3% yield with a 25% payout ratio. And this company actually has a rule where 60% of all the free cash flow that they make, so this number right here, the FCF, the free cash flow, 60% of all of it will be returned to the shareholder either through dividends, special dividends, or stock buybacks. So this is a very shareholder-friendly company that's committed to returning, 60% of their free cash flow profits to you, the shareholder. So that's what I like about them. Another stock I've been buying is ticker symbol Build. This is a fintech. They're not a bank, but they have like their own credit card and stuff like that where Bill collects these transaction fees on all this. So look at their subscription and transaction fee revenue. It's up 18% year over year. So they're seeing some real growth. I mean, look at this growth right here. It's very consistent. That's what I really like about this company. They're a pure growth stock. They don't actually pay a dividend or anything, and they're not net income positive yet. But look at the free cash flow. The free cash flow is up 69% year over year. If we look at their net income right here, look at that. They're barely free cash flow positive now. They will be next year. They actually just expected to make $2 of EPS in the next year. And if we look at their EPS right now, like they literally just made 8 cents in the most recent quarter. So They're pretty much just now going net income positive, but hopefully that was helpful. Another stock that just reported earnings was Nike, and the earnings were actually not great. Of course, I'll show you their net income year over year. Look at their net income; it's down 26% year over year. So their net income really got hit year over year. But the new CEO is like, we're going to go back to sports mode, or to more sports themed gear and clothing. Bring the cool back to Nike is what the CEO said on the call, which is kind of cool. But anyway, we got 16 shares of them. We're still down 9% on our position, but I do like them. I'm looking to potentially increase my position into Nike. Once I'm down, like if I'm down 15% on them, I'll really start buying more of that stock. And lastly, we'll look at Powell Industries right here. This one we literally bought, what was it? Oh no, in January. We bought this one this year. We bought it on January 9th, 2024. So literally at the beginning of the year, we bought this one and it is up 211%. It is up triple. And that is because this company right now has $350 million of cash. Look at the market cap, it's $3 billion. So more than 10% of the market cap right now is still just cash. And look at the PE ratio. They're trading at 20 times earnings, 20 times net income. And look at this right here. Here's their net income. It's up. This is the net income. It's up 75% year over year. This is some crazy growth. And here's their top line sales. Their sales are up 31%. Great growth. Debt free, lots of cash, low payout ratio. And that's why that one has done so good. And, I'm not allowed to sell a stock once I buy it in this portfolio, but even if I was able to, I wouldn't be selling this one right now. They're trading at 20 times earnings and like 15% of their market cap is just cash. So I wouldn't be taking profits on that one. We are also chilling on some cash right now. Check that out. We have $1,024 of cash. So what's cool is you get a 4.10% APY. If you want to get this app, it's called Moomoo, or I have an affiliate link in the description below. But that is our Moomoo portfolio. Now let's head over here back to our Robinhood account. Look at this. The past week we're down 4.2%. We've had a past rough week here, but luckily the most recent day on Friday, we had a nice little recovery there, but here's what I own in here. I kind of already showed you, but we got Salesforce, McDonald's, Google, Constellation Energy, Meta, and Realty Income. Every stock in here pays a dividend, and let me show you my dividend income or all my previous. Uh, yeah, so check this out. Here's our pending dividends. We have one coming in from Salesforce and Meta again. Most of these are dividend growth stocks. Like you're not buying Meta because of the dividend. You're buying them for the stock price appreciation because I'm up 32%. And the $1.50 is kind of just a cherry on top. So they're expected to grow their dividend a bunch in the future. But yeah, I have changed a little bit of holdings in here. Like we get dividends from Google, McDonald's, Realty Income. Like we don't own some stocks in here. Like we don't own DNUT anymore. We don't own any Krispy Kreme stock anymore. But let's actually just go back to the beginning. So here's January 2024. So yeah, look at this. We used to own a lot of weird companies. Look at ticker symbol RWAY. We had a 243. Dang. How's that stock doing real quick? I know. Yeah, so look at that. I'm kind of glad I sold that one. Look at that. This doesn't include the dividend, but they're down 17% all time. Anyway, that's why you got to be careful with the higher yielding stocks. And we also used to own NSA, National Storage Affiliates. We had 200 shares of them. See, my portfolio has changed so much, and I'm finally happy I've picked a strategy that I really like. It's a nicely diversified portfolio of companies in the S&P 500 that all pay dividends. And most of these a growing dividend, like except Realty Income, but all my other ones actually every stock besides McDonald's and Realty Income has a dividend yield of under 1%. So all these have really low dividend yields, probably not super attractive to other people, but for me as a young investor, these are the kind of stocks that I love, the ones with low payout ratios and a lot of room to invest in the future, do share buybacks, all without diluting the shareholder. Like Realty Income, every time they want to acquire new assets, they have to dilute the shareholder. So, but even still, you look at the AFFO per share because the per share includes the stock-based comp. I'm kind of drifting off here. I apologize. But so let's just get back to the portfolio here. So this is my Roth IRA. And now Roth IRA is just a tax-free retirement account. So if you like double your money on a stock in here, you don't pay any tax, but you can't withdraw it till you retire. But my Roth IRA is really boring. We just own one stock in here, ticker symbol BRX. It's actually a REIT, a real estate investment trust, where if I held that in my taxable account, it would be a non-qualified dividend and I have to pay a higher tax bracket on it. But whenever I receive a dividend from like McDonald's, they pay a qualified dividend. I actually pay 0% tax on it. Even in my taxable account, because I make under $50,000 a year, which is pretty cool. But anyway, let me show you why I love all these companies here in my Robinhood portfolio. Like this stock right here, Carlisle. I'm going to be very quick with this because I know you've probably never heard of this company before, but here's why I love them. This company has bought back over 7% of the company just in the past year. So that's a 7% non-cash dividend yield. Look how many shares outstanding exist. Well, that's the diluted weighted average shares. It's the exact same thing as total common shares outstanding, except it includes employee stock options. But look at how many total common shares exist right now. It's on the left, 45.4 as of the most recent quarter. If we just zoom out to 2019, it was 55. They buy back so much of the company. And also, if we look at their diluted EPS, or here, we're going to look at the earnings per, yeah, here's their diluted normalized EPS. It was $5.39 in the most recent quarter, and their annual dividend cost $4. So anyway, every quarter, their dividend cost $1. They're almost a dividend king. They're at 48 years of raising their dividend. Their dividend is $1 per share right now. And as you saw, they made $5 of diluted normalized EPS. Well, look at their net income. In the most recent quarter, they made $246 million of net income. It's on the right now. So remember, they made $246 million in the most recent quarter. And guess how much their dividend cost? Literally only $45 million. And the only reason it went up from 40 to 45 is because they just rose their dividend by over like 20% or something. It went from like 85 cents to $1. So great dividend growth here. They're going to be a dividend king soon. They're very financially stable. Like, look how much cash they have. It's on the left. They have $1.53 billion of cash on hand. Total debt of $2.29 billion. So because they have a lot of cash, look at this. They actually just started making interest for the first time. They used to pay interest on their debt. Now in the most recent quarter, they made $4 million of interest because of their cash on hand. So yeah, here's what I mean, that they're returning so much capital to the shareholder. This is why the shares outstanding are down 7% year over year. They spent $1 billion plus just in the past year on stock buybacks. And if we look at the market cap is 17 billion, 17.15 billion. And they spent $1 billion plus just in the past year on share buybacks. Anyway, I'm buying this one for the dividend growth. Come back to my next video. I'm probably going to buy 2 more shares of this company whenever I get paid next, because the valuation looks very attractive right now. Their free cash flow yield is 5% plus. Anyway, that's why I love that company. Carlisle, ticker symbol CSL. Next up, we got Salesforce. This is a perfectly diversified company. They're in the software industry. They have a lot of software that a lot of companies can't switch to another provider. Salesforce is the best and only one, so they have some lifelong customers here. But anyway, I'll be quick with this because I like looking at this company's numbers right here. Just look at their net income. They literally, back in 2023, it used to be very choppy, sometimes even lose net income. Now they're very consistent with their money. They're making a bunch of net income and they're making a bunch of free cash flow. In the most recent quarter, they made $2 billion, but they have that one quarter of a year where they make $6-7 billion. So right now they have $12.76 billion of cash. Their dividend only cost $382 million. Remember, that's easily covered by their net income and their free cash flow easily. And a total debt of $8.4 billion. So they have way more cash than debt right now. And how much are they making interest? Well, here's their total common shares outstanding. Look at that. You actually own 1.34% more of the company. So they're buying back stock and they're making interest on their cash. Yeah, very nice. And yeah, look, they're doing a dividend now. And look at the stock buybacks that they're doing. So Salesforce, I think, is a very shareholder-friendly company now. They've really turned things around here since 2022 at their bottom right here. They talked about their year of efficiency. So I love Salesforce. They got a growing dividend. I don't know about their valuation right now. Their valuation looks high right now. I wouldn't be adding to my position. I'm not going to be adding to my position, but I'm a very happy Salesforce shareholder. So next up is McDonald's. So this is actually a real estate company. Every McDonald's tenant, McDonald's, the parent company, owns the land under it. So every tenant has to pay McDonald's to be on that land. So I could show you their plant, property, and equipment, their land value. They have nearly $50 billion of land, which if you do a multiple on that, roughly half, I'm just going to do a prediction here. I don't know if this is true, but I'm pretty sure like half of McDonald's market cap is the real estate value. If you look in the tri-state area, the triangle of every, city, McDonald's is always in the most prime real estate locations. Anyway, next up is Constellation Energy. I actually have been buying a bunch of this one. The stock that literally hasn't been public for 5 years, but is up 400%. Let me show you my buy history right here. We've actually been buying a bunch of shares recently, like December 10th, December 18th, 17th. We've been buying up this company like crazy. Out of all the nuclear facilities in the United States, this company owns 55% of them. So if you want exposure to the nuclear industry, the purest way to do that is ticker symbol CEG. And they also have a utility business like in the natural gas. We at like my house right here, our house, we have our natural gas bill through Constellation Energy. So now whenever we pay the bill, it doesn't bother me. But anyway, here's Google right here. This one, Google is finally innovating. They're proving that they're an innovative company because they just released their new quantum AI chip called Willow, and it's really pleasing investors. A lot of investors like this news. So now we're up 18% on our Google shares. This company is literally perfect. There's nothing wrong with this company. Everything financially about Google is perfect. I'll be really quick with this because we all know how great Google is. Look at their net income. It just hit a record, up 33% year over year to $26 billion of net income. So what is Google doing with $26 billion a quarter? Well, look at their share buyback, their stock buyback program. They spend over $15 billion every quarter buying back their own stock. So Google's a very shareholder-friendly company. Remember, they're spending $15 billion a quarter on share buybacks. Look how much they're spending on their dividend, only $2.5 billion. So if instead they chose to spend all their money instead of buybacks on dividends, Google right now, if they could triple, quadruple their dividend. They just choose not to. That's what I love about these low yielding, low payout ratios companies. They could double, triple their dividend. They just choose not to. So that's what I love about them. Same with Meta. Meta's equally such a great company. I mean, we'll be quick with this one too because everyone knows Meta, and I'm actually looking to buy more shares in this company because if we look at this company's EPS right here, look at the EPS growth. They just hit a record EPS of $6, and look at their free cash flow per share. Dang, I didn't even realize this. It was nearly $10 in the most recent quarter of free cash flow per share, and their dividend only cost 50 cents. And they're about to raise it too. Check that out. I wonder what their dividend will be this next quarter. But what I'm trying to say is they can easily afford the dividend. Look at their net income. It was up 35% to $15.7 billion. And their dividend only cost literally $1 billion. So here's Meta. They could double, triple their dividend if they wanted to. How much cash do they have? It's on the left here. Look, they have I don't believe this. They have $71 billion of cash. And are they doing share buybacks? And they're also buying back their own stock as well. This is why you can't sell Meta or Google long term. This is why I'm just going to literally hold on to these companies forever. Meta is a share buyback machine. I mean, it's not as great as Google, but they're half the market cap. Well, not half the market cap. Actually, I wonder how close they are in market cap now. So if we actually go over here to the mega caps and look at the market cap. Yeah, so there's Google at 2.3, Meta's at 1.5. I can't believe Tesla and Meta are almost the same valuation, and Tesla makes literally a tenth of the net income. Tesla has a ridiculous valuation, and lastly here, we have Realty Income stock, everyone's favorite dividend company. They actually have the trademark, the monthly paying dividend company, or it's stock, I don't know. Anyway, they actually pay you a monthly dividend, and I just made a video. Now's pretty much a really great time to buy Realty Income. They're down 14% the past 3 months. I mean, they're the lowest they've been in a long time. Look at that. This is the 5-year chart without the dividends reinvested. If you add 5% for every year, you're just about break even. But anyway, I'll show you my dividend history right here with this company. Look at that. We get $7.91 every month from this company, which is kind of cool. And they actually just rose it. Like I used to get $7.89. Now I get $7.91. So that's what's cool about Realty Income. I'm not looking to add any more to my Realty Income position. As you saw earlier, I've actually been adding on to my CubeSmart position. But yeah, guys, that was pretty much my entire stock portfolio update. The next stock I'm really looking to buy more of is Carlisle because this one's literally down like crazy just the past month. 13%. The valuation looks amazing on that one. And also more Constellation Energy, even though the valuation isn't great. Like, what's the PE ratio they're saying right now? The PE ratio is a 25. I mean, that's actually not crazy. A PE ratio of 25 right now isn't nuts. But those are the two stocks I'm really looking to buy in 2025. I mean, there's so much that could change in 2025. Like, you remember my portfolio at the beginning of 2024 was so different. But now I think I'm going to be a lot more consistent now. I'm going to own all these same stocks. And if you're wondering who I am, actually, the main thing I do now is I live stream on TikTok. It's Nathan Robert on TikTok. We stream every day, twice a day that the stock market's open on there. And I also have a Rust YouTube channel whereas that used to be my main thing. Now I like to do this full time. Uh, but not full time, but I just like doing this more than that. But yeah, thank you all for watching. Hope you have a great rest of your day. My name's Nathan Robert, and if you leave a comment, I'll respond to every single one of them. And also drop a like for me. I never mentioned that. Please drop a like on the video. Hope you have a great rest of your day. Thanks again. Y'all are the best.